Hello to anyone who's on the stream. I'm just doing a quick sound check. We'll be starting in about 4 minutes. Thank you. Alrighty, let's get started. Thanks again, everyone, for helping me with the sound check. My name is Brian Bonatti. Welcome, everyone, to the Vitamin T series provided by Tradictive. We are a technology company that provides an indicator called AutoUFOs, where we help provide buy and sell opportunities mechanically through the markets. Let me start with a disclaimer today. Disclaimers: the following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and does not guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Today, we're going to be talking again about risk management. If you missed our last session, we have the recording on YouTube, and we recommend that you go see it. We cover how to calculate the risk per tick on the futures contracts. And again, I have a big cheat sheet of, I'm composing a big cheat sheet of all those individual contracts. Email me if you have the desire to see it. Once I have it out, I'll let it be announced here in the sessions. If you're interested in the indicator itself, you can go to www.tradewithufos.com/bb. You'll be guided through a two-step process where you can sign up for the AutoUFOs app either on TradingView or TradeStation. So a quick outline of today's lesson. We're going to go over purpose a little bit more, and then we're going to be talking about Forex leverage. So last session, which was Monday, I kind of jumped right into leverage straight from risk management. So the title of the whole series is risk management, but what does that have to do with leverage, which is what I really started the lesson with and what we're going to talk about today as well. So while I explain why we're going into leverage in the first place, I would like to ask in the chat if anyone knows what the 90-90-90 rule is. I'll be waiting for that. So I'll be answering here. What is the 90-90-90 rule? So risk management involves managing our risk. It's as simple as that. We have money in the market, and we want to make sure that we are not going to lose it all, okay? So our priority is to stay in the game as long as possible and earn money through consistency. We don't want to be all-out bettors and win in one trade. We're always being consistent with our profits, and we know that by stacking the probabilities in our favor, in the long run, we'll be profitable traders, okay? So I haven't seen anyone answer what the 90-90-90 rule is in chat, so I'll start explaining it. The 90-90-90 rule is 90% of new traders lose 90% of their account in their first 90 days of trading, okay? 90% of new traders lose 90% of their account in their first 90 days of trading. And what happens after that? Usually they give up because it's discouraging. 90-90-90, go, go, go. It looks the same, but no, not quite, Jose. So we don't want to be a part of those novice traders because losing 90% of your account is going to make you quit, A, or B, you're going to have to come back into the market with a whole new brand new account, start from scratch. Hopefully you've learned your lesson the first time because you didn't bet everything in one trade or over leverage yourself, and you don't do it the second time. But that doesn't happen most of the time. Usually people make the same mistakes, right? So this is what the 90-90-90 rule is, and that's what we're trying to avoid. We don't want to be the 90% statistic. We want to be the 10% statistic that is consistent with our profits by staying in the game. And the only way that we can stay in the game is to manage our risk. It's not to have the most magnificent indicator out there in the world. We obviously are very supportive of AutoUFOs, and we love the tool. It saves us time and gets us where we need to be. But even if we were 99% accurate with every trade that we had, I can confidently say that if we're not managing our risk properly, we have the risk. We are likely to be in that 90-90-90 rule because we can over leverage ourselves and blow our accounts. That's the number one reason why traders quit when they first start. It's because they just blow everything in the first trades because either they don't understand their risk, or they get too emotional and they break their rules on risk. Okay, so that's the core of why we are learning the leverage aspect of risk management, because we want to understand how much money are we risking with every trade that we have. And in order for us to do that, we have to understand the basics behind how leverage is calculated in the different markets that we're trading, okay? So hopefully you guys understood how to work with futures. And if you have any questions, again, email me, and I'll try to help you with that. But today, let's cover how to calculate risk in Forex. So I think the easiest way to start explaining Forex leverage is just through examples, okay? So risk in Forex is calculated through a couple of different things, and I have them listed here in numbers. So the top three are the most important. So it depends on your account currency. So if you're in the US and you're trading, your account is funded with US dollars, then that's what your account currency is. And then your lot size, which is determined by when you create your account, you can select a lot size of three different things. And again, we covered this way back, I think in order management or something like that, a video. It's a vitamin T series video. So go back if you're not sure what different lot sizes exist, go back and study that in one of our videos. So lot size is the other factor. And the last factor is our currency pair that we're trying to trade, right? So here's our example. We're trading in US dollars. Our lot size is a standard size. In other words, we have $10. It's a pip is a standard of $10 if we're trading, in this case, our off pair in US dollars. So here's our example. Our currency pair that we're willing to trade is the euro US dollar. Now notice how our currency in our account is the same as the off pair or the quoted pair of the currency Forex pair that we're trying to trade. Therefore, every tick is for futures. Pips are for Forex, okay? So every pip value, every change increment in the euro US dollar Forex pair is going to be a $10 account change, okay? So this is kind of the standard when we're going for calculating pips values, okay? We want to match our account currency to the currency pair that we're wanting to trade. In this case, our quote currency is the same. In this case, it's a US dollar. And then we multiply, let's just do that. And then, so it will be the size of our standard lot, okay, in this case. So it's $10 per pip in this case. Let's go through another examples where we tweak a little bit, okay? So here, our account currency is still a US dollar and our lot size is still the standard lot size. Now, however, we're trading the US dollar, Canadian dollar. Now, US dollar is still part of the currency pair, right? It's still in there. However, it's not the quote currency that we're trading in this pair. So what we need to do is simply divide our standard lot size amount, which isn't a standard, so it's $10, by the currency pair quote. So what is the value of the US dollar Canadian dollar pair? Okay, that just means that we're going through what the currency exchange is. Okay, so let me bring up TradingView and we'll go look at how much the US dollar Canadian dollar is trading for. Okay, so the dollar CAD, I'll zoom into this, is trading at $1 and let's say 33 cents, okay? You want to be more exact than that, so go all the way out to your further decimal place, so it'd be 32947. And I got this from yesterday, so yesterday's value was at $1.32.32372, okay? So what we're doing is we're grabbing this pair's value, which is the dollar CAD, and we're going to divide it by our lot size because just some quick calculation arithmetic here. We want the dollar to be our numerator, so we're going to divide this so that it's in the denominator, okay? So just dividing 10 by 1.3237 0.72 gives us $7.55 per pip. Okay, so every pip change increment in the US dollar Canadian dollar pair is going to be a value of $7.55. Okay, because we're trading on a standard lot. All right, so one more example here is going to be a little bit of a little more complicated. So what happens now if our dollar account currency isn't in the pair that we're trading, right? So in this case, we have an off pair of the euro and the GBP, or the pound. Here, a lot size has changed now to a mini, so it's $1 standard. I shouldn't use standard. So standard is the lot size. It's $1. I'm not sure what the right word should be for this, but I'm just going to use standard, okay? So the standard is going to be $1 per pip. But we have to convert that dollar to the currency that we're trading, okay? So our currency pair is, again, the euro pound. Now we need to convert this the pound, into a dollar value, right? So the way we do that is we now go into what the value of the pound dollar is. Got it? So let's again go into trading view. So we have the euro CAD right now. Let's get the pound dollar. So make sure we're in Forex. Click. All right, so here it is. We can update. Let's see if I can scroll over. No. So the current value of the pound dollar is $1 and 0.2474. So I just grabbed, again, the value from yesterday, which was 1.24697. And now I can just multiply my lot size by the conversion value, which is, again, because we want it to be in US dollars, we have to convert this pound into the equivalent in US dollars. So we're going to multiply our lot size by the conversion value of 1.24697, and we get $1.25 per pip. Okay, so I'm giving you guys the hard way because it'll help you understand what happens behind the scenes. How do we calculate all these values, etc. There is, of course, an easy way. So I'll show you guys the easy way now. You can either put this URL in your link, so it's the forex.com, or you can just Google forex.com margin pip calculator, and you'll bring up this site, okay? So this site will help you with the calculations that you want to, that you're gonna need in order to understand how much you're risking per trade. Got it? So again, our example just now was in the miners. So let's click the currencies here and go down to miners. And our base currency is the US dollar, although there are different options here that you could use. So now we want to go scroll down to the euro pound. So all the way down here, euro pound, it's saying the pip value is 12 cents. Why is that? That's because we are in a micro contract size setting. We want to increase that to a mini, which was our example. So instead of 1,000 contracts, which is the micro size, we increase it to 10,000, which is the mini size. And there we go. $1.25 per pip in our account will be in that increment in the Forex, okay? So you can do this with any lot size and any currency, and it will give you the value of a pip in whatever account currency that you're using, okay? So this is the easy way to do it. I don't really recommend you doing it by hand. I just want you to understand how these different values are derived so that, you know, we demystify as much as this as possible. You have now the power to do it on your own, but just because it's faster, just go into forex.com and grab these different parameters. So if we had a standard lot size, it'll be $12.47 per pip, okay, that we're going to be risking. And that's per contract of the Forex pair that we obtain. Okay, so now we know how to grab these. Definitely take a look at the majors as well. Of course, these are easy for most part because our base currency is US dollar, and a lot of the major pairs are in dollars. So it's going to be either $10 or 10 cents or $1, or it's going to be the inverse of it, which in this case, 8 cents, 9 cents, etc. Okay, so that's how we calculate risk for Forex pairs. Okay, so if you're trading Forex, make sure you review this as much as possible because it's very important. Again, we don't want to be part of the 90-90-90 group, right? We want to be consistent traders, stay in the long run, build our wealth, build our portfolios, and just be successful in life. So if you have any questions, reach out to me at bb@tradective.com. You can also go to www.tradewithufos.com/bb, where you can access and sign up to the AutoUFOs app, where we provide you indicators of where to buy and sell in any market out there. If you have any suggestions or any questions about anything that we've covered or you want us to cover, please send me an email or give us a comment out in the YouTube video down below. I appreciate everyone showing up today. We'll meet you guys again for the Vitamin T series and risk management part 3 on Monday. Thanks, everyone. Have a great rest of your week.